Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it. On average, over the last 20 years, September has been the worst performing month for the S&P 500. Many note, however, that this is more of a function of magnitude more than frequency, with September posting a monthly decline slightly less than half the time but experienced a decline of more than 7% 4 times. The broader direction of the market is not governed by the calendar, but there has been a tendency for volatility to pick up as the summer winds down. September ranks number 2 and October number 1 in largest average monthly moves, with 35% of years in the last 2 decades experiencing a move up or down of more than 6% during one or both months. With the economic and earnings expansions far from exhausted, many do not think that conditions are ripe for a dramatic sell-off. But the coming shift in monetary policy stimulus could be a spark for increased market fluctuations this fall. The economy has been running hot for much of this year, but recent data are signaling that a patch of more tepid growth may be on the way. The rate of US GDP growth has peaked, and the impacts of the Delta variant have spurred concerns of a fading recovery. Many view this as a mid-cycle slowdown, one that is inevitable given the impact of stimulus checks and the initial effects of reopening the economy, and two, that will prove temporary with above-trend GDP growth persisting next year. The August employment report released on Friday was consistent with a recovery enduring some growing pains. Monthly job gains totaled 235,000, well below expectations and a drop of 800,000 from July. Job growth in the leisure and hospitality sectors stalled, highlighting the impact of renewed pandemic restrictions. Many characterize this as a soft patch, not a sustained new direction for the labor market. Coupled with the downturn in recent customer confidence readings, this does signal potential weakness in consumer spending for the third quarter. Nevertheless, many think a gradually improving labor market will be the backbone of an economic expansion that has plenty of life left. The S&P 500 has risen more than 20% year to date, making 2021 the ninth year since 1991 in which the stock market was up more than 10% by Labor Day. The market posted an additional gain from September to year end in each of those instances, averaging another 8.8%. This highlights the inertia of a strong bull market. However, many expect returns to be more modest as we advance. Strong corporate earnings growth this year has supported market gains, while at the same time reining in elevated valuation, price to earnings levels. With a sharp jump in earnings and with profit margins at record highs, expectations are for nearly 10% earnings growth again next year. This should form a solid foundation for equity market performance, even as the economic growth simmers from a boil and monetary policy spigots slow their flow. Anyways, that pretty much wraps up the financial news for this week. Now I'm going to hand it off to as usual to discuss the financial term for this week.
Hey guys, for this week's financial term, we're going to be discussing a popular term in the stock market, short interest. Short interest are the number of shares sold short but have not yet been covered or closed. And this indicator is representative of the market sentiment, as the higher short interest is, the more likely or the more negative investors think about the stock, which is of course why they're shorting it. When investors are overly pessimistic, however, it can lead to a sharp increase in price at times, and as all investors close their shorts simultaneously. Stock exchanges measure and also report on short interest. Typically, they issue reports at the end of each month, giving investors a tool to use as a short selling benchmark. The Nasdaq exchange also publishes a short selling report at the middle and end of each month, I believe. Shorts with extremely high short interest readings but very small shares floated are the most susceptible to short squeezes. Short squeezes occur when investors buy a particular stock, causing a sharp increase in the stock price, which then forces the current short sellers to buy to close as a means of covering their position. This then again increases the price, setting a chain reaction. One great example of this recently is GameStop. all the institutional investors who are shorting the stock currently were forced to buy to cover, as all the Redditors were buying up the stock. And that again caused the stock to go higher. Because as you know, when someone buys a certain security, it does cause a minimal increase in price. Short interest can also be converted into a ratio called days to cover. Do this by taking the number of short shares and divide it by the average daily trading value. Ideally, the higher the ratio, the more bearish investors are on a given security. It can also be an inverse indicator, however, as when a stock is under extreme selling pressure, it may be due to a reversal of a similar magnitude. However, under no circumstance should any investor use short interest as a direct reason to buy a particular stock, buy or sell a particular stock. This goes with almost everything involving in the stock market, but all of your stats and analysis should point to a similar conclusion. Your overall analysis should include several different metrics and measurements. Again, just in short, this is just an indicator as it means to say, okay, maybe it's a potential stock to dig deeper into, rather than saying, okay, the short interest is really high on this, it could be due for a reversal, and let's just buy it. It's maybe not the best idea, right? Anyway, that's all I have for you guys today. Thanks for watching. If you liked the video, please drop a like on the video and subscribe if you haven't done so already, as it really does help the channel grow. Thanks a lot, guys.